The $360 question, your bank very likely owes you about $360 a year. They have for years. They will continue to until you do one specific thing about it. If you have $10,000 in a typical savings account at a big traditional bank, Chase, Bank of America, Wells Fargo, Citibank, you are earning in 2026 somewhere around $40 per year in interest. The national average savings rate, according to the FDIC, is currently sitting around 0.4%. If you took that exact same $10,000 and put it into a high-yield savings account at 4% annual percentage yield, same FDIC insurance, same liquidity, same access, you would earn $400 per year instead. That's a difference of $360 per year for literally no additional work, no investment risk, and no lockup period. Welcome back to the Friday Dollar. I'm publishing one video every Friday answering one specific money question with the real math worked out. This is episode 2 today. How high-yield savings accounts actually work, why traditional banks pay so little, and exactly how to switch, including the part about why most people never do, even though it's the easiest free money on the personal finance board. How banks actually make money on your deposits, to understand why traditional banks pay you 0.4% while online banks pay 4%. You have to understand what banks actually do with your money. When you deposit money into a savings account, the bank doesn't lock it in a vault somewhere. They lend it out. They lend it as mortgages, as auto loans, as credit cards, as business loans. The bank is paying you interest to borrow your money cheaply, then lending it out at a higher interest rate. The difference between what they pay you and what they earn from lending is called the net interest margin. That spread is fundamentally how every bank makes money. Screen animated diagram, your deposit bank loans interest spread. Here's where it gets interesting. The Federal Reserve sets the floor for interest rates in the economy. In 2026, the federal funds rate sits in the 4.25% to 4.5% range. That's roughly what banks can earn risk-free by parking your money at the Federal Reserve overnight, doing nothing with it. So a bank that takes your deposit and pays you 0.4% is conservatively earning at minimum 3% risk-free on the spread, often much more when they actually lend it out. They are profiting on the gap between what your deposit is worth in the marketplace and what they pay you for it. This is not illegal, immoral, or unusual. It's how banking works. The question is just, how big is the gap and who keeps the difference? Why traditional banks pay 0? 40%, the real reason. So why don't traditional banks pay you more, given the obvious gap? The blunt answer, they don't have to. Traditional banks know something powerful. Most of their customers will never leave. People keep their money where they keep their money. The friction of switching, even though it's actually pretty low, feels high. People remember their account number. They have direct deposits set up. They have automatic bill pay. The branch is convenient. They've been with the bank for years. All of these add up to what economists call switching costs, and traditional banks specifically benefit from them. Dot on screen. Visualization of switching costs, direct deposits, auto pay, branch convenience online banks, Marcus by Goldman Sachs, Ally Bank, SoFi, Capital One 360, Synchrony, American Express, and dozens more operate on a completely different economic model. They have no physical branches, they have lower overhead, they have no 35,000 bank tellers to pay, and critically, they're competing for your deposits in a way that traditional banks aren't. Online banks need to attract customers from somewhere. The somewhere is people leaving traditional banks. Their competitive weapon is the APY. The higher rate is how they pull deposits from Chase and Bank of America to themselves. Right now, in April 2026, the actual numbers look like this. Marcus by Goldman Sachs, 3.50% APY. American Express High Yield Savings, 3.20%. Capital One 360 Performance Savings, 3.10%. Ally Synchrony 3.50%. SoFi up to 4% with direct deposit. Lending Club Level Up 4%. Bank rates track top rates have been hitting up to 4.21% in recent weeks. Compare those to the 0.40% national average. The gap isn't subtle. What high yield actually means in 2026, quick clarification before we go further. Some people hear high yield savings account and assume there must be a catch. Higher risk, less safety, lockups. There isn't. A high yield savings account is a normal savings account at a normal FDIC insured bank. The Federal Deposit Insurance Corporation insures your deposits up to $250,000, the same as at Chase or Wells Fargo. Some online banks like SoFi extend that coverage further through partner banks. SoFi advertises up to $2 million in coverage. Your money is just as safe in a Marcus account as in a Bank of America account. Often safer in mathematical terms because of the additional FDIC reach at the online banks. There are some real differences worth knowing. First, no physical branches. If you want to walk in and talk to a teller, online banks can't help you. Capital One is the exception. They have actual branches in some Northeast states, Texas and Louisiana, plus the highest APY among any bank with branch access. Second, ATM access varies. Some online banks reimburse all ATM fees. Others have limited ATM networks. Most people don't withdraw cash from savings, but if you do, check this before switching. Third, and this is the honest one, APYs are variable. They move with Fed rate changes. The 4.0% you sign up for in April 2026 may be 3.3% next year if rates fall, or 4.3% if rise. Your account stays open and active. The rate just adjusts. This is true at every bank, traditional or online. The difference is that online banks adjust faster and stay competitive. The switching math, how much you're losing. Here's the part that does the hard work in this video. Let's run the actual numbers. On screen, calculator showing each balance lost interest. If you have $1,000 in savings at 0.4% APY, you earn about $4 per year. At 4% APY, you'd earn $40. Lost interest, $36 per year. Real, but not life-changing. If you have $5,000 at 0.4%, you earn $20 per year. At 4%, you'd earn $200. Lost interest, $180 per year. If you have $10,000 at 0.4%, you earn $40 per year. At 4%, you'd earn $400. Lost interest, $360 per year. If you have $25,000 sitting in savings at 0.4%, you earn $100 per year. At 4%, you'd earn $1,000. Lost interest, $900 per year. For some viewers, that's almost a month of rent. If you have $50,000 in savings, and many viewers in their 30s and 40s do, at 0.4%, you earn $200. At 4%, you'd earn $2,000. Lost interest, $1,800 per year. Every year you don't switch, the compounding adds up. 5 years of not switching with $25,000 in savings is roughly $4,500 of interest you didn't earn. That's a real, recoverable amount of money, and it costs you about 30 minutes of paperwork to fix. How to actually choose one now, the practical part. How do you actually pick one? Don't optimize for the absolute highest APY. The bank with the highest rate this week may not have the highest rate in 3 months. Chasing rate is a treadmill that doesn't pay much for the effort. Instead, optimize for these 4 things in order. First, APY in the top quartile. Anything in the 3.5% to 4.0% range right now is fine. The difference between 3.5% and 4.0% on $10,000 is $50 per year. Worth caring about, not worth obsessing over. Second, no fees. No minimum balance requirements. $0 to open, $0 to maintain. Any account that requires you to maintain a minimum balance to earn the APY is hiding in plain sight. Avoid those. Third, smooth user experience. Mobile app that works. Easy ACH transfers in and out. Reasonable customer service hours. The savings account is going to live on your phone. It has to be a phone you don't hate using. Fourth, institution you've heard of. This isn't strictly necessary. There are no-name online banks with great rates, but for a savings account, recognizable name reduces the cognitive friction of trusting it with your money. Marcus by Goldman Sachs, Capital One, American Express, Ally, SoFi, Synchrony. These are all FDIC insured, all have track records, all clear the bar. Don't agonize over picking the perfect one. The difference between the third best and the best on this list is small. The difference between any of these and your traditional bank is large. Focus on the move that matters. The 30-minute setup checklist. Here's exactly what to do this weekend. Step 1, pick a bank from the framework above. 5 to 10 minutes of research max. Step 2, go to the bank's website. Click Open Account. The application takes about 10 minutes. You'll need your social security number, your driver's license, and the routing and account numbers from your current bank for the funding transfer. Now, Step 3, fund the new account. Transfer some, not all, of your savings as a test. $2,000 is plenty. ACH transfers between U.S. banks usually take 1 to 3 business days the first time. Confirm the money arrives. Step 4. Once you've confirmed it works, transfer the rest of your savings. Don't keep redundant balances at your traditional bank savings account. That's the entire point. Step 5. Update your direct deposit if you want the new bank as your primary, or keep your old checking account at your traditional bank for direct deposits and just maintain the new HYSA as your savings vehicle. Either approach works. Many people keep their checking where it is and just move the savings. Total time about 30 minutes, spread across 2 days. Total cost, 0. Total annual return, somewhere between $100 and $2,000 depending on your savings balance. This is the easiest legal money you will make this year. Next Friday, that's how high-yield savings accounts actually work. The math is real. The switching is easy. The hardest part is doing the thing. Quick, honest note before we close. APYs change. The 4.0% you see today might be 3.50% next year. That's true. But your traditional bank's 0. 40% will also adjust, usually downward, when rates fall much faster than they raise it. The gap isn't going away. Tell me in the comments, what's your current savings APY? And how much money are you currently leaving on the table? I'll do the math for you in the replies if you tell me your balance. Next Friday, AI just replaced 9 million finance jobs. We'll walk through which of those jobs are gone forever, which are coming back, and what to do with your money in a world where every customer service rep, paralegal, and bookkeeper might not be human anymore. See you then. I'm the Friday Dollar, your Friday afternoon money advisor. Hit subscribe. See you next week.